First, I'd like to encourage you all to register for our webinar, which we're having at 7 p.m. Singapore time on August the 21st. You can find the registration link on the utrade.com.sg website. And the reason I'm so excited about this webinar is we have a very famous guest speaker that will be Dan Ives of Wedbush Securities, who is one of Wall Street's most famous analysts. Dan, of course, is a noted bull on Wall Street. He's been very bullish tech stocks. And part of the reason he's been so bullish is Dan's a big believer of all the opportunities for companies created by artificial intelligence. Today, when I came into the office, I saw a negative headline for artificial intelligence, at least in terms of some stocks. And the headline on Bloomberg said, billions wiped off software companies due to AI disruption. And if you go into the story, it basically said that these big software companies, for instance, SAP, whose share was down sharply last night, or in the US, Adobe or Salesforce, these shares have been doing badly because people feel that AI will make it easier for customers to switch to other products. There was a quote in the article from Sam Altman saying AI could lead to the fast fashion of software, meaning instead of buying your software at Takashimaya, you're buying it at Uniqlo. To put that in perspective, I can do that from my own personal experience. I use a Intuit product, TurboTax, to do my US taxes. I've been doing that for a long time. I would be very reluctant to switch to another software, even if it's cheaper, because I'm so used to the way TurboTax works. But if AI makes it very easy to use someone else's software and it's cheaper, yes, I may switch. And if you look at a big company that's maybe doing digital marketing or some sort of graphics, if they're using Adobe and they have someone leave, it's very easy to find a replacement who's already fully trained on using Adobe software. But if the software, due to AI, becomes incredibly easy to use, maybe the idea that the new employee needs to be trained becomes less important and encourages you to switch to another form of software, the Uniqlo software, if you will. Who knows, but basically that should make it more difficult for these big software companies to raise their prices every year. So in the case of Adobe, over the last 10 years, its PE ratio is averaged like 45 times. Today it's trading at 17 times. So the market is already priced in that its software sales are going to be much less sticky going forward than it is in the past, and the company was probably going to be less able to raise prices than it has in the past. So is it a good value now? I've had a couple of colleagues here say that they're thinking of buying these companies. What I've said to them is, you know, you could be right because they do look cheap basis their history, but I didn't see any immediate catalyst for those stocks to turn around, because really if you're buying today, you're just waiting to see how well they weather the storm of potential competition from AI. And that's a story that's going to take a long time to reveal itself. Okay, so going on to the next topic. Even though software companies have been doing very badly this year, the US stock market has been doing very well. We're at a record high. Last night, we're up 2% over the last week. And in fact, last night we had a very good move. And that move came after a CPI number came out. That CPI number actually showed inflation ticking up, but it ticked up in a way that kind of was in line with expectations, and that led to expectations for rate cuts by the Federal Reserve in September to go up. So you got a number that was as expected, and rate cut expectations went up. Why did that happen? Well, the general consensus is that the reason inflation ticked up, and as I said, it didn't tick up as much as expected, but the reason inflation's ticking up is because tariffs are increasing prices for US consumers. And if they're only ticking up as they were expected, then the general view that the uptick in prices will only be temporary from the tariffs. It won't lead to a long-term type inflation, and the Fed shouldn't be concerned with it. That expectation becomes more certain, and then you get rate cuts more likely. Let me explain this in a different way so you see what I'm trying to get to. Think about CPI measuring consumer prices. So if you have an item that costs $1, and now there's 5 cents of tax added to it, it now costs $1.05. So you have inflation there. But the Fed is really concerned with preserving the value of the US dollar. So if you look at the situation from the Fed's point of view, well, the US dollar still buys the $1 a product, and you just need another 5 cents to pay the tax. So the dollar really hasn't diminished in value, it's just you need more dollars because of the tax. And actually, if you think about it, if it turns out at the first blush, or the first thing, that the tariffs lead to a temporary inflation, after that it should lead to disinflation or prices even dropping, because what you're doing with higher prices is discouraging consumption. If people are buying less stuff, prices tend to go down. And you can also see that signs of that in other parts of the US economy that are not affected by the tariffs. For instance, if you look at home prices across the United States right now, in counties all across the US, home prices are dropping. And if you ask ChatGPT, to go back to AI, is it very common for there to be inflation while home prices in nominal terms are dropping? ChatGPT will tell you, no, that's not very common at all. So it doesn't seem like inflation is going to be a big problem. Prices are going to tick up because of the tariffs, but it's not something the Fed will necessarily react to. And in fact, the Fed may go ahead and start cutting rates. And that seems to be what the market's doing. That's already priced in the market. That is why we're at an all-time high. Now, when I say that tariffs are going to result in higher prices, I start wondering whether I might receive some nasty comment from Donald Trump. Well, why do I say that? Well, because Jan Hatzius, who's the economist at Goldman Sachs, he put out a note saying that ultimately that the costs of tariffs are going to be borne by the US consumers. And Donald Trump didn't like that. Donald Trump basically yesterday said that Jan Hatzius should be fired because he didn't like that story. And this actually reminds me of an older story from Donald Trump. I'm going to have to look at my notes here. There was an analyst with Janie Montgomery in Philadelphia in the early 90s named Marvin Rothman, who wrote a report saying that the Trump Taj Mahal was issuing junk bonds, and those junk bonds were bad bets. You shouldn't buy them because he felt that the Taj Mahal would not be able to service his debt. And Donald Trump got extremely angry at this guy and called for him to be fired. If you read Donald Trump's The Art of the Deal, one of the things he says is, I don't pay attention to the critics unless they interfere with what I'm trying to accomplish. So obviously, Marvin Rothman was interfering with Donald Trump's ability to finance the Taj Mahal. It made him very angry, but he wasn't really criticizing Marvin Rothman for bad analysis, because it wasn't bad analysis. The Taj Mahal wasn't able to pay its debt. It did fail. So if you follow that logic, even though Donald Trump is being critical of the Goldman Sachs economist, it's still entirely possible, or maybe it's even likely he'll turn out to be correct, and those tariffs will result in higher prices for US consumers. To go back to me being criticized for agreeing with Jan Hatzius, it may sound ridiculous, but I just want to share with you an anecdote. People who listen to me talk, they know that about 4 weeks ago, I was commenting on Johnson & Johnson, and I was pointing out that the market was getting more confident in Johnson & Johnson's stock because the management team there had made such good decisions. There had been questions whether they had overpaid for a big acquisition, Abiomed, the company that makes the heart pumps, and that acquisition is turning out to looking okay. And the other smart thing they did, apparently, is sell off their consumer product, their over-the-counter drug business. That's something into a company called Kenvue, which they don't own any shares in anymore. And since they've done that, Kenvue shares have really languished. Mentioning those points on my webinar, a few days later, I'm looking and I see a notification. Someone from Kenvue had looked at my LinkedIn page. So they obviously have some software that sees that I'm talking about Kenvue on the YouTube or on Facebook, and that prompted somebody at Kenvue to say, who is this guy? So maybe the same thing will work. I've kind of said, oh, Jan Hatzius is right about tariffs causing inflation. Maybe someone in the White House will say, who is this Paul DeVierno saying that? So finishing things off right now, I'd like to say, what do I see from the market going forward? And going forward, I think the US market might pause a little bit because we're pretty much done with earnings reporting, with the exception, I guess we have NVIDIA coming up, so we're not going to have the catalyst of good earnings. And the market's already assuming the rate cuts from September, so that piece of good news we're not going to have. So we could have a little bit of pause in the US market going up. Meanwhile, maybe some interest in European markets will get revitalized. And the reason I say that, at the beginning of the year, European markets were outperforming the US market, and I think part of the reason was expectations of a peace deal in Ukraine. Some people might disagree with me about that, but I think that is a positive for the market. Those expectations didn't pan out, but now on Friday we have this meeting between Trump and Putin. There isn't very high expectations about that meeting. It'll be complicated to get a ceasefire or a peace deal done, and it doesn't seem like the groundwork for that has been done, but still entirely positive. It will be a positive meeting and will increase hopes that there will be a peace deal. So maybe that'll start encouraging a little bit more interest in Europe. So I wouldn't be surprised over the next several weeks if we see European markets outperforming the US market. That concludes my weekly talk.